Hello, good afternoon, everyone. Welcome to all of you for today's session. Just let me know whether you people can hear me well. Can you hear me well?
Hello, yes.
Good,
Yes, sir. Can you?
Yes, sir. Yes.
good. Right. So, students, the point is, let me link my iPad with it and start the whatever we have planned for today. Yes. So, students, now advanced audit and assurance. As we know, everyone, the examiner of ACCA subjects, they keep on introducing new changes. They keep updating the course, the syllabus, or they keep changing and updating the marking scheme or the way the examiner, drafting technique. So this time, the people who are going to attempt exam in the March, they should be familiar with the latest exam approaches, latest exam techniques. Otherwise, if you are going to attempt it with the old techniques, you are likely to score less marks, So the point is, you have to be more practical now. If I say advanced audit and assurance is now more practical way it is being tested. Before, there was some gap. The audit in practice, right now, is still there's some gap, but they are trying to make it work like a real audit. Okay, so this is the approach basically. So the same approaches, skills required to pass the paper. What are the required to pass the paper? Knowledge and content is the base. And normally now what happens now, since we know there are out of 100 marks, 20 marks are professional skills marks and 80 marks are technical knowledge marks. Technical knowledge. So what our examiner is now doing, that they have made it in one sense, it is easier. But in the other sense, it becomes difficult when you have to think critically as per the situation. And you have to do some analysis. You have to try to connect the dots, spread across the scenario. So 20 professional marks. Actually, if I say they save you time in exam if you are well prepared for them. It means whatever you are writing, you have to write 1 or 2 or 3 lines extra on different aspects, and you will be getting good marks and passing the paper with good marks. But if you are not working in that dimension, it will become difficult for you. So anyways, we will be talking about it. So how to practice question means it is not slide for you. You can go through it yourself. So planning, the materiality, because today's topic is audit risk. Today's topic we have to discuss, that is audit risk. And it is basically risk-based approach of audit. Risk-based approach of audit. That whenever auditor works, that materiality is very much important. Auditor consider auditor does not waste time on those matters which are not important, which are not significant. Because time is everything for auditor. Service provided, it is a service. So that's why auditor, first of all, whenever any matter is there, auditor considers the materiality of the matter first, significance of the matters. And now the practical approach is that at planning stage of audit, when auditor is getting understanding of the entity, considering its operations, considering business level, auditor calculates materiality threshold. And that threshold is calculated as a reference point. This threshold that is calculated, reference point later on to decide whenever some matter comes in my mind, comes in front of me, I can easily assess whether this matter is material, it crosses the threshold or not. So how to decide materiality? There are certain benchmarks available practically. 1% to 2% of assets, total assets. 0.5 to 1% of sales, or 5% to 10% of profit. You should memorize these benchmarks. These benchmarks you should memorize, reference points. Because in exam, what happens? Examiner gives you the scenario requirement now. And in the email, there is exhibit 1. There is always exhibit 1 in question number 1, where examiner asks you to calculate and material, where email examiner asks you different requirements. And in that, just 1 minute, there is one student who is unable to join. Just a minute, just 1 second, please. Just 1 second, please. So examiner basically asks you to calculate materiality. Actually, partner is telling the manager that you will calculate materiality or consider the materiality based on profits, or you will consider the materiality based on sales, based on profits. So whatever, so if you don't memorize the benchmark, you cannot calculate materiality. So 3 benchmarks you must memorize. Now, so first of all, benchmark. And then what you do is you calculate, for example, in the email, partner says you will calculate materiality based on profits, for example. So what we do is we say, okay, how much are the profits for the year of company? We immediately go to the exhibit where total profits are given. Financial statement extracts are given. Profit before tax or whatever is given, the final figure. The profit is, for example, it is given is for 45 million. For example, the profits are given 45 million, for example. And now, based on profit, we know that the benchmark of materiality, first of all, you will give this heading. I will be drafting answer with you when I will be going to the past paper question. But here I will be, first of all, preparing you that how we will proceed. So benchmark of materiality, you will give heading. This is subheading. Overall, so you will be writing the answer and you write here materiality. The main heading is materiality. Materiality. And you say materiality is to be calculated based on profits as suggested or as directed by partner. Okay, as directed by partner. Yeah, just a minute, students. Just 1 second. Let me connect iPad. Actually, iPad got disconnected. Just 1 second, please. Yes. Now, so 5% to 10% of profit of company, whatever XYZ. And next, what will you be doing? Next, what you will be doing next? The next you will mention here that, for example, this is the profit, right? We calculated. Then you will mention here 5% of profit of company XYZ is, so 5% into 45 million. How much it is? How much it is? 2.25 million. And 10% of profit is $4.5 million. So lower threshold and upper threshold, both we calculated. Now, if you have done this, your 2 marks are done. Only writing them. Complete. The next point is, you have to justify that you have to tell I am using this materiality for my question, for my audit, and what is the logic, and 1 mark for that. You see. So you see here what you'll be doing. For example, the company is a new audit client. Company is a new audit client of our firm. We have not audited them before. So XYZ is a new audit client of the firm. So the firm, not being familiar enough with its accounting and financial system, financial matters. So, in order to perform detailed audit testing, materiality for overall financial statement is decided at, what is the lower threshold? 2.25 million. Now, if you do this, your 1 mark is done. Means you have to justify. Amount is not important, I'm telling you again. You may say, I decide 1.5 million, less than the lower threshold. Choice is yours because of the high risks of the company. Company is doing some fraud if you have gone through the scenario. Management has poor integrity. For example, another example, if the company is, we are auditing, audit firm is auditing the company since number of years. They have been auditing them since number of years. So in that case, when they're auditing them, what is the problem? The problem is that, not problem, we have the enough knowledge and there is no significant change in operations of the company. You will see the logic. Sales have been grown by a small amount. Assets have been increased by a small amount. No significant change in the operations, no diversification, no growth. You have to give logic. That's why we will be using, for example, I say, what is the materiality? This. We will be using materiality 3.5 million or 4.5 million. Logic is important. Is it clear so far?
Yes, sir.
Good. Now, so when you are discussing materiality in the audit risk question, so we have learned so far what we have learned. We have learned the first thing, that is, we have to state ratio of threshold. Means 5 to 10% of profit. First of all. Okay. Second, we have to calculate materiality upper and lower threshold. Which says, you know, why we are calculating for profits here? Because it is given in the email address, email exhibit address, I'm saying. Email exhibit. I will show you when I'll be solving the question. And the third is, choose overall materiality amount and justify it, that why you are using it. So if you do these 3 things, 3 marks in the audit risk question. Done. Next. The next point is, so risk-based approach of audit. I'm not going in this unnecessary detail. How auditor understand the entity risk identification, inquiry from the management, staff, observation of operation, inspection of documents, Analytical procedures. What are analytical procedures? And they are very much important at risk assessment stage. Analytical procedures are very much important in your questions as well. How? I will tell you. Students, analytical procedure comparison last year with industry average, with the budgeted, with the projections. So they are done. And then ratio analysis is performed. Ratio calculation, profitability, liquidity, risk, etc. GP margin, NP margin, these are different logics explained. Of course, I will be explaining when I'll be solving the question. Why I have given it here? Students, right now, when we say, that for the audit risk, two skills are used, professional skills. I will show you here. These skills are used. 3, analysis and evaluation skill. Analysis and evaluation skills is wholly solely based on that how you use ratios, trends to justify your point. How you use that. Yes, the data, financial data, and I will be, of course, talking about it. So that's why when we are explaining a risk, when we are trying to link to risk, so we need to, of course, this skill helps. This skill has marks, Next. So explaining the risk of material audit risk is basically has two elements. The one is risk of material misstatement, and the other is detection risk. Risk of material misstatement, that some item in financial statement may be recorded at incorrect amount. Yes, if that is recorded at incorrect amount, that profits may be misstated, understated, overstated, assets, expenses. Risk of material misstatement. So for risk of material misstatement, you have to, how to explain audit risk. That how something may be misstated. Specific to the scenario. You cannot write, copy paste from one scenario to the other. I did one question. I wrote this answer there. I will copy paste it here as well. No. Facts. If facts of this scenario are different, you have to discuss, analysis of the situation. Judgment on the professional judgment is skill. Judgment has to be applied on the scenario. And any IFRS applicable, think of and discuss. And how to discuss, I will talk about it now. So which specific item may be understated, overstated? Now come here. So evaluate. Now this is your examiner says, evaluate and prioritize. Now the requirement is evaluate and prioritize. I think I can write the spelling correct. Prioritize the audit risks in the scenario. Now, prioritization of the risk. Prioritization. Evaluation. So 2 points are there. And we will talk about the both. So each audit risk is 3 technical marks. Remember, properly explained as per scenario. Now, The point students do a mistake. Remember, when you are discussing the audit risk, the approach is same, which I have been telling again and again. That materiality we have already discussed. We have to consider materiality of the matter. We have to discuss. But how? Now we will discuss in materiality. For example, we have decided materiality level 2. What we decided about? We decided materiality level 2.25 million, right? 2.25 million we decided. Yes. So for example, we have decided materiality level 2.25 million above in the materiality section. Now we are discussing a matter, property, plant and equipment, for example. And we know that that property, plant and equipment is having a value of 12 million. How we will discuss it here? Materiality will say it is 2.12 million, which is much higher than materiality threshold as discussed above. Much higher, much greater than that. So it is highly material in this way. Okay, one thing. Second point is, now if there is an accounting issue where IFRSs are applicable, IFRS. So accounting treatment concisely explain relevant accounting treatment as per IFRS. As per IFRS, concisely give that. For example, they say the company has, let me give you example. The company has purchased a property, plant equipment 12 million. And they have 4 million license as well, which they have capitalized. Total 16 million capitalized. Now, license fee as per IES 38, we will say license fee can IES 16 says only those costs can be made part of the cost of asset which are directly attributable to bring them in their current position and location of their use. And license fee is now applying to scenario. So when we say treatment, so a very important part is apply to the situation. And here students do blunder in the exam. Either they miss it or they miss it. And when you are missing any one, you are losing 1 mark there. Either if you don't apply, forget any mark. Because examiner say, I have not given you this is not financial reporting paper that you are giving only accounting treatment, right? It is not SBR or FR. You have to tell impact, audit aspects, which item may be misstated, which item may be, and how. How? So apply to the situation. So just like that, you will say here that license fee is not a cost to bring asset in the location and condition for its use. So it must not be capitalized in this way. And then you will say the impact. Impact, risk and impact. That they have incorrectly capitalized, hence property, plant, and equipment is overstated. Right? Property, plant, and equipment is overstated. Now, and intangible assets are understated. You have done it. Now, here comes some further commercial acumen mark. Being an audit approach and skepticism as well. That since they have recorded wrongly, license fee should be amortized over, it is 5-year license fee, for example, over 5 years, as per IAS 38, over its useful life. Since they have made it part of the cost of asset, it means they may be depreciating it over the asset's useful life. Again, expense is understated. Assets overstated. You got my, this is commercially, link. Auditor is thinking that how logical it is. Now, so we have to discuss the whole day, this 5 hours, same thing. It is just start. Now, come here. So you see here, each audit risk has 3 technical marks. This is a minimum. Some risks have technical marks up to 4 to 5 as well. Just like that, I found an issue of license fee. It will be amortized over its useful life, license. Okay, but it has 1 professional mark as well. So got 1 professional. So 5 marks for this point. You got. So I said apply professional reporting knowledge to the specific information in order to evaluate where and how risk arises in the scenario. Where and how risk arises in the scenario. Now, next point. The next point is impact on risk on financial statements. I have told you. So the same thing, materiality is the first thing. Okay, right. Materiality. So materiality. So MTR, same. MTR, I, risk impact. Now, yes. You see here, demonstration of recognition of potential management bias. Wonderful point. Listen, linking to the same point. It might be possible. Management may have, for example, company is going for application of loan. So they might have overstated deliberately property, plant, equipment. Deliberately, they may have overstated just to show healthy financial statements, to show bigger amount of assets available for security against loan. They may be biased. You got that point? So if there is another point in the scenario, you can link it here as well. And if you do 1 mark for this point. So the next is, yes. Scaling the risk. Scaling the risk. I will explain it. Scaling. When a such point will come. Right now, I'm ignoring it. Okay, I will come to this. Now, I'm sorry. So, professional mark in audit risk question. Okay. So in the analysis and evaluation skill, there is one mark available for, in the requirement, it was there, the prioritization. You have to prioritize risk. Now, what is prioritization? Prioritization is that you will pick bigger risk first, the most significant risk first, then the second, then the third, and so on. 2, 3, the most significant risk should be discussed first, and later on all other. Now, significant, what they are. Significant risk, where bigger amounts are involved, for example. Bigger amounts. For example, 50% of assets. Out of the risks you have identified, the most significant, the first. And one more thing. And at the end of audit risks discussion, you will add a paragraph conclusion. You will add a paragraph conclusion. Yes. And in that paragraph, you will tell why you have chosen the first, second risk as significant. You will tell there. You will explain which risks are priority during audit and why. Why? Because they are material.
Papa, tu casse-les. Faut bien écouter là.
Which risks are priority and why? Okay. Now, so risk 1, risk 2, risk 3, and that's it. So next. So the second, so 1 mark for this, a mark for prioritizing. And explanation, 1 mark for prioritizing, placing, discussion order, and the second is for why it was, explanation, which I'm saying in conclusion paragraph. Why it is important? There is no specific correct answer. It is just a demonstration of thought process. Whatever you write, it need not to be that this one standard answer. Your thought process, whether you are thinking like auditor or not. Why I consider these important. And this can be, I prefer conclusion. Discuss there. Next, the next point. Professional skepticism. So professional skepticism, I have highlighted 2 points in it deliberately. The first one, that management has decided, for example, management says, in our opinion, it is not probable that we have to pay any amount to the claimant in a case. So challenging that, why they might be wrong, not taking that assumption. We are not recording that provision. We are not disclosing any contingent liability. So challenging that on solid grounds that management may be wrong. Skeptic. Or minimum up, there might be a possible obligation. If an employee got injured at workplace, there might be implication. Management may be reluctant to highlight. Deliberately, management biased to show that. not to show that, not to record that, because it may hurt the profitability. They may have to pay. And yes, from bias, specific risks of the management bias. Now, where may be the risk of bias? Example, which you can find in the scenario. Some example I will tell you. I cannot make up risk of bias. Risks of management bias. Example, companies applying for loan application or negotiation. Listing, company is going for listing. Going for listing or newly listed. Management bias. Directors' bonuses. That is bonuses. Linked with either profits, either assets, whatever it is. 4, existing loan covenant. Linked with financial performance. Government grant linked with performance or other aspects of financial statements. Instances of why management may be biased. Some examples, but remember, you will not find always these examples. Examiner may come up with such a scenario where you can find some other example of management bias. For example, one more thing came to my mind. Management is listed, the owners are manager, and a dividend payment for family dominant company. Family is dominant, all the public shares are also held, but dominant is one family. So what management can do? Management can manipulate that. Just to draw higher dividend, they can manipulate financial items to get a more dividend. And if you can see the dividend payments, if they have increased, some incorrect treatments are there, you can justify. You see, management has done it. So you see, management bias. Now, next. Skepticism is required to link the risks. Wonderful. Different risks that management may not record it. For example, some certain expenses to avoid breach of covenant. They may have done some wrong treatment deliberately. The linking of different risks across that. Now, commercial acumen. Commercial acumen is that how the world looks. One thing, how things are there, and how auditor looks that. This is one is that company is doing something. Now, what is the approach of auditor? One is the approach of the auditor regarding audit processes, tight deadlines of audit, for example. Now, how auditor will approach that? Company say we have to complete this listing process completely. So auditor will think from himself, okay, they have to do this, but I have to do my work. How I will do that? I have to do some mid-year work. So that at year end, less work is to be done. Detection risk, no audit risk. So this is the practical impact on audit. So another example is given here, by the way, now. So students, this is how the audit risk have to be. Now we all need to, I have just given you a quick overview. Now we have to apply all that when we will be solving the past exam questions. Any question, anyone so far? Any question, anyone so far? Please let me know. Anyone, any question, please. Okay, great. Now, the next point is, so I will be opening the exam platform here in front of you guys. And just a minute, please. Just 1 second, please. Wait, it is too slow. Yes. So students, we will be doing the questions, the latest exam question, which is available on the practice platform. Come here. December 2022, latest one. It's September. Okay, here it is. Yes. So you see here, this is requirements are the same. Response to the instruction in the email from the engagement partner. Okay. Now, next point. The next point is, it is 1st July 20x5, your audit manager. Okay. It is a year ending is this, right? A specialized country, really specialized small domestic pets food, right? So this is the partner's email. And what I'll be doing, I'll be opening the briefing notes along with it, because I can't waste my time. Time is the most important factor. Now, so to the audit manager from this, and immediately I will copy this data. Yes. Immediately I will copy this data from here to, okay, subject, okay, yes. Now, so here things will be different. So to, from, communication marks, you know, communication, it is communication. I'm working for communication marks. Yes. So it is 1st, right? You can put 2nd July, one next day. Okay, 1st July, so 2nd July. We have done in planning in one day. Okay, we are going to respond then. And the first paragraph is introduction paragraph. Introduction paragraph. Yes. Now, hello. With the year end approaching, I need you to start planning that this data is visible properly, or should I enlarge it a bit? It's okay? Or just zoom in? Okay, I think now it's okay. Right. Here we come. With the year ending approaching, I need you to start planning the audit of M company. I met with the company's finance director, Kate Fleming, last year to discuss recent development for the business. I have provided with the summary of the matter discussed at the meeting along with some projected financial information based on what I have done on this industry. It is appropriate for you. What is it? Materiality. I told you they will tell what is the benchmark for materiality. They will tell you. Profit before tax. Okay. So if you know all that process, 3 marks are done for you. I don't know why students lose mark. You know, 7, 8 marks are simply very easy to gain. And sometimes students come to me, Mr. Hamzah, I got 27 marks. Can you help me in AAA? I say, how many 27, 30 marks? Oh my God. I simply can't digest that. That if you have studied AAA, how 27, 30 marks? So anyways, come here. So introduction paragraph. Evaluate the business risk, right? So, and then is the significant, you see here, evaluate and prioritize the significant risk. And now communication marks are available. You have not to discuss it, what they are saying. I repeat my words. Communication mark is available for this fact that you have to stick to the requirement and follow specific direction. If you do not discuss it, communication mark is there for you. Now, so the next point is discuss the conclude. You should use all exhibits. Okay, very good. Discuss and conclude on the impact which outsourcing the control function will have on our planning. Design the principal audit procedure to perform a holiday pay obligation. Okay, I guess 19. Great. Now, employees' benefits. So students, following, briefing notes. Briefing notes. Sorry. Briefing notes include the evaluation of business risk faced by Mercurio Company. And significant risk of material misstatement have been evaluated and prioritized. Evaluated and prioritized. Moreover, impact of outsourcing of credit control department has been on our audit planning has been discussed. And lastly, it includes the principal audit procedures to be performed in respect of holiday pay obligation have been given. Yes. Now, next. So the next is, A part is evaluation of business risk. Which we are not doing right now. B part is related to risk of material misstatements. This is our topic. The questions to be solved. Now, so students, C part and D part we feel heading as well. Now let us start with the risk of material misstatement. The first is materiality. Materiality. Now, as per the partner's direction, overall materiality of materiality at financial statement level of company will be based on profitability. First of all. The second point is benchmark. 5% to 10% of profit before tax. Now, so we will go immediately financial information to confirm these marks for us. Yes. Profitability. It is 60 million. 60 million. So here we can say, so materiality will be 60 into 5%, 3 million. Will be 3 million at 5% and 6 million at 10% of profit. Yes. Now, so students, this is existing client. We need to check. Just a minute. Existing client or new client. They have not mentioned it is a new client. Yes. So we can say that they have not mentioned. So students, as in order to decide materiality level at financial statement level, judgment needs to be applied. Judgment needs to be applied. Yes. So, being the Mercurio company, an existing audit client, yes. So, now the point is, one more thing. Now we can leave it over here and proceed further because we need some more information. That whether the company is under any pressure, any changes, any loans, any legal issues. If there are any, we can tailor our answer as per that. If there is no such issue, we can say here it will be 6 million because there are no such issues, no changes, no problem, no biases. Otherwise, our logic will be different. Now, so starting with the background information. I will be a bit, yes. Now, just a minute, please. Let me arrange it. Because I am concerned about you people, whether you are able to see it or not. Now. Yes. So, Mercurio Company is a large listed company established 15 years ago when the founder observed a growth in demand for pets-related products in the country, with over 7,000 employees who are mainly staff workers working in the stores, as well as selling pet products. Okay. For a wide variety of things, the store also sells small animals, such as rabbit and fish. Staff members are fully trained to give advice to customers on matters including nutrition and general animal health. And staff members are also trained in handling all types which are sold. Some stores sell more unusual pets, such as spiders, snakes, and reptiles, and require compliance with specific import restriction and standard welfare. Okay. Now, students, if you start doing some student do blunder, speculation here, company may not be compliant with those over here. Okay, so means that might be a business risk, but not risk of material misstatement. Remember, Mercurio, these are business risks. Yes, you can say, you can discuss. Mercurio also operates veterinary clinics with most of its stores. Clinics are staffed to fully qualified vets who offer a range of veterinary services. Customer can pay as they go for appointment and treatment for the animal, or they can take out annual pet health care plan. Annual pet health care plan. Right? Focus. Which are extremely popular as they offer good value for money to the customers. The annual income, great. Now, what I will be doing? Revenue recognition. I will simply give here heading recognition. Simply copy paste. Remember, note down this point with yourself. For one point, for one risk, you may find information spread across multiple exhibits. Just like I left this materiality discussion incomplete. Why? Because at start, I cannot say the points here. I cannot say until unless I get the information. Now, next. The next point is, and this is what your Gander says, that whenever information is spread across different exhibits, you have to utilize all that analysis and evaluation skill. And judgment is also that you need to utilize all the relevant information to give a judgment. Now, next. The cost associated with healthcare checks have been risen over the recent year. However, they have not been able to increase the prices due to customer price sensitivity over pet healthcare plan. The company's accounting policy is to recognize from the healthcare plan with now. Here came. You see here, healthcare plan. When, how they recognize? When the plan commences. Half they recognize. So I have simply copy pasted it there. Now, student, business risk I'm not talking right now. And you know, they are popping in my mind right now and I'm reading it. So anyways, let us proceed further. So financial information is here. Revenue is here, 745 to 803. Profits, margins we can calculate, of course, we will be doing that. Total assets, rapid increase. Assets related to stores purchased from Lake Wall, $171 million. Okay. Trade receivable, goods in transit, 3, holiday pay obligation. In my opinion, these are the 4 risks. There are 4 points are there. Employees number increasing, bank loan. You can see analytical procedure. I'm seeing that too much increased. Now, although they have not added any explanation for it. Now, this is the critical approach of auditor that you have to identify this point. Loans. So gearing ratio increased. Current ratio, okay, improved. So Lake Wall company, right? What they are saying? They're saying that, okay, don't do this. Okay. So to expand into new location, 20 stores were purchased from Lake Wall, a clothing retailer on 1st May 20x5 at a cost of $171 million. Mercurio's company purchased a store using their cash reserves. Lake Wall was facing going problem and offered the store to be sold as a part of restructuring program. The store need to be completely refitted at an estimated cost of $9 million. Mercurius management has not decided how many of the store will be retained for use. Any which are not retained will be sold. These stores will be refitted during the period number. Now, what I'll be doing, simply copy pasting it here. So it is the another audit risk of minimum statement. So acquired stores. I simply copy pasted it. 171 million. Because there are a number of points to be discussed in it. Now, goods in transit. In June 20x5, the Mercurio company purchased 12 million of pet food supplies from an interest supplier with the sales contract stating that ownership of the goods passed to Mercurio at the date of shipping. During transit, the ship carrying the goods was involved in an accident which destroyed the entire supply. The director has arranged insurance on the shipment of goods and the policy states that 80% are covered by insurance. The latest correspondence insurance was an informal bill that, okay. So goods in transit, 40 to 12 million. It is still held at 12 million. Goods in transit, 12 million. Goods in transit. The next point is here. Holiday pay obligation, right? Mercurio has an internal department who has been testing the control in the company's payroll system. Internal audit procedure have revealed that some employees are duplicated on the payroll system. It seemed to have happened when two different systems used for recording full-time and part-time were merged in October 2024. Additionally, the audit team procedure have found that while the system has capability of recording holidays taken by the staff, this is not always used, really. And manual record are also maintained in relation to the holiday entitlement. Then what is it? Controls issue. Okay, employees are entitled to carry forward a maximum of 3 days of unused holiday entitled to the next year. Management estimate holiday pay obligation to the unused holiday encashment. Yes, I will be doing. I will try my best to do this. Okay. Students is asking, will you share the answer? So I will. Don't you worry. Okay, I will. Now, so, and use the previous obligation and listing it to the pay rise and change staff leaves. Right? So we will simply copy holiday pay obligation. Yes. Holiday pay obligation. Now, so next point. Students, the issue is here that one thing. Just a minute, please. Gearing ratio. Come here. Loan increased. Right? So loan increased. So I'm thinking from the perspective of that materiality. We can see the profit margin we can calculate. Simply we can copy, do these calculations here. Okay, in the spreadsheet. So profit margin. So we can simply copy whatever we want to from here. Copy and paste it here. Oh no. We can copy. Why you locked this? In exam, you can copy? Tell me. In exam, you can copy? I used to copy and paste. It is not allowing me right now. I don't know why. It's not allowing me right now. Anyways, so we can calculate GP margin, profit margin, net profit margins. Can calculate. Okay, just a minute. You're right. We have to use the command buttons. I forgot, right? Because then it becomes easy to do this. No. Anyways, so net profits for 20x5 is equal to 60 divided by 803. And here it is 56 divided by 745. Yes. Fallen, decreased. Sales have been increased. Sales increased. That is equal to 803 divided by 745. Yes. And minus 1. We can calculate percentage. Yes. So sale have increased by 7.8%. Right? Margin, net profit margin, and then GP margin. GP margin. Yes. No, operating profit margin. Yes. Operating profit margin. We can calculate this as well. 172 divided by 803. Yes. Next. 110 divided by 745. So you see here, operating profit margin increasing and net profit margin decreasing. You see here, this is the point. Now, and they have obtained loan increase. We have to do all these percentages here. 75 to 251. Oh my God, 251 minus 75 divided by 75. Percentage increase in loan. Why? Yes. 251 minus 75 divided by 75. This is too much increase. 235% increase in the loan. And gearing ratio have increased by this. So they have increased the liquidity. Yes, liquidity increase. So we can, let me try to copy once again these ratio from here, if I can. Oh, finally succeeded. Okay, thank you. Okay, now. So now, here we are. So now this whole data is in front of us. We will be utilizing it to support our discussion. Okay? Anything we missed? Nothing, I think. Anything we missed? Assets, cash balance is falling. You see, cash balance is falling. How? Receivables. No, receivables we have not seen. Yeah, we have not seen it, receivable. Majority of the sales are for cash, increasing number of credit accounts. The company offers credits 60 days to pay for goods. The forecast trade receivable balance at 30th September 20x5 is this. Too much receivable. Due to, you see here what is happening here. 60 days. So what I'll be doing, this is something risky, receivable issue. Yes. So students, receivable. Receivable. Yes. Now they have increased too much. Cash balance falling, decreased from the last year. So student, it is analysis is done. Analysis of the question is done. We have gone through one more thing. Just 1 minute, please. This I have not seen. What is in it? The fourth exhibit. This year, they have seen significant business development for the company. The company has started to sell product under its own brand, Mercury range of premium pet food and accessories. The products are manufactured in another country and imported, and purchase of Mercury brand goods from foreign supplier to be $7 million. The range was introduced for the sale in January and was heavily promoted. Some of the insignificant, how a projection in the management account is that 30% in the next year. Okay, right. Additional bank loan. This is pressure. Bank loan. Additional bank loan. Too much. So we can write here now for the materiality discussion. Yes, the company although the Mercury company is an existing audit client. Yes, but it has taken huge amount of loan this year for expansion. For expansion. For purchase of properties, yes. Better word is that. Of properties. Properties. So and they might be, and they have diversified, and they have started new business. They have done diversification because they have launched new brands. Expand. Yes. So there are high risks that financial statements may be manipulated to attract the loan or to comply with loan covenants. Yes. Yes, there might be. So there are high risks of material misstatements in financial statements. So materiality should be set at 5% of profit before tax at an amount of $3 million. So you see here, this is how it has to be done. Now, next point. The next point is revenue recognition. Students, first of all, we will discuss all the points and then we will arrange them as per the amounts involved, prioritization. Now, students, they say 10% the pet healthcare plan's annual income accounts for, sorry, just a minute. Plan annual income accounts for 10% of company's revenue. 10% of revenue. How much is the revenue? Total revenue? 803. So 80 million, 10%. So which is above the materiality threshold. Hence, it is clearly material to financial statement of company. Now you see here how you will write like this. Materiality done, discussed. Now, so students, the company's accounting policy is to, now what we will do? Relevant accounting treatment. We have read it. What is the relevant accounting treatment? What IFRS says? Let us discuss what IFRS says. If you do not remember the IFRS number, no worries, but it is IFRS 15. As per IFRS 15, revenue should be recognized when performance obligation is satisfied. When performance obligation is satisfied. Now applying to scenario. Here, annual health care plan fee is received in advance, applying to scenario. So revenue should be recognized. One point is here which I'm missing. I think I copied, but it is not pasted here. Just a minute. I copied that, but it is not here. Why? Just a minute, please. Revenue. There was a point. Quarterly health check. You know, it is missing. I did it. Quarterly health check. Yes. Should be recognized over time after the quarterly checkup of the pets. Yes. Now, so quarterly. As with each quarter checkup, performance obligation is performed by the company. Now, students, this is where you people do not apply. You simply start to say, okay, it is performance obligation is satisfied. Simply, or you don't try to bother the points at which you don't try to link that point. Now, but the company is recording the revenue from sale of health, the sale of healthcare plan, at the time of, on the date. The plan commences. Now, so student, what is the point? The point is, so recording. So they are recording revenue before at incorrect time when performance obligation has not been performed. Sorry for my typing errors. Unperformed. So the risk is that. Means risk that revenue is overstated at year end. And liabilities which are basically deferred income, income are overstated in the financial statements. Okay. Yes. So students, this is one complete point for 3 marks. Done. But we have not to score only 3 marks. Now, we have to link it with other points. So, as the company, yes, is growing, company is growing and expanding its operations, the management of company might be under pressure. Now, we can write here further. Yes, management bias. Another heading, the risk. Yes, management bias. Can give that. So management of the company may be under pressure. Under pressure to show increased performance or boosted performance of company. And in order to do so, they might be recording the revenues as from plans, annual plans, in advance as revenue, as discussed above. As a part of earning management techniques. You see here, earning management techniques. Yes. Secondly, operating profit have increased by how much? Increased, we have calculated that. We have done that calculation. Yes, here we are. Operating profit is increasing from 14.8% to 21.4%. Yes. While operating profit's margin have increased from net profit. Yes. Is net profit? So yes, profit before tax. Profit before tax has a slight decline from 7.52% profit margin percent to 7.47%. You see here. But what we want to drive, so students, it might be possible this is inconsistent trend as profit margins may be misstated and they may have manipulated operating profit margin. Now here one thing comes to my mind. What comes to the mind? Loan. Immediately loan came to my mind, that there might be the loan covenants. Is there any? Bank loan information. Yes. They have loan with cash flows. Okay. No information here. Right. We don't have information about the loan linked with it. So still we can say, as it may be a loan covenant attached with new loan raised. Yes. That's it. And it may be overstated. It may be over. You see how to link from different aspects. Bias. Now, next, covenants. The next point is, yes. The next point is acquired stores. Acquired stores. Students, if you pardon me, please. Actually, I'm getting late it is prayer time actually. I will take only 10 minutes break, if you allow me. I'll be back in 10 minutes after prayer. Actually, the time is limit for that. Okay, just 10 minutes break. I'll be back in 10 minutes. Okay, I just looked at the watch. 10 minutes break, I'll be back and I'll continue. Okay, thank you for your understanding.
Okay.
Yes, everyone now. So we were discussing goods in transit. Sorry, acquired stores. So what is a 20 store were purchased? Okay, this is the cost, highly material. In my opinion, it should come first. Biggest amount, 10% of revenue was 80 million. And this is the biggest amount so far. Mercuro purchased the stores using their cash reserves. Lakewell was facing going concern problem and offered the store for sale as part of restructuring program. The store need to be completely refitted. Okay, they say they have to refit the store, right? And they have not yet how many stores will be retained for use. Any which will not be retained will be sold. So students, the point is they have purchased the property, which first they will refit. It will be their property, plant, equipment, non-current assets, and which they are going to sell. They should be used. They should be classified as held for sale, investment, held for sale. Now, so students, so this is the point. The point is the 20 million stores, 20 store purchased. Oh my God. What happened? Just a minute, please. Oh my God. Something wrong happened. It got closed. Just a minute. Let me try to open it. Just a minute, please. I hope it will be recovered. Finally, thank God. Yes. So 20 acquired stores unnecessary. We will delete stores 20 stores acquired at a cost of 171 million are highly material to financial statements of company. Highly material. Yes. This necessary, unnecessary. Yes. So here, yes, it will be sold. The stores which have to be refitted and used by the company. For its business purposes should be classified as property, plant, and equipment. Equipment. While those properties which has to be sold should be reclassified as held for sale if they meet the criteria as per IFRS 5. If you don't remember 5, don't write 5. Now, we have to explain what IFRS 5 says. We have to explain, accounting treatment. As per IFRS 5, an asset can be classified. We have not to write detailed everything, all criteria. Students do blunder. They start writing everything they know. Or what they say, they don't write only this. And they say, my job is done. These are two extremes. We have to follow a moderate approach. Relevant some points. An asset can be classified as held for sale if management is committed to sell the asset. Sell. And it is likely to take place, mean disposal, in next 12 months. Actively, asset is actively being marketed. Being marketed. Yes. And if it is so in this case of some of the properties of company, some of the acquired properties of the company, they meet the criteria to be classified as held for sale. Held for sale. Now, the risk is that classification of these properties may not be correctly done by a company. Risk is that. Yes, this is the risk. No, secondly, so as per IFRS, property, plant, equipment can be recognized at cost. At cost. While asset held for sale must be, you see, only relevant chunks of IFRS held for sale are measured at lower of carrying value and fair value less cost to sell. Fair value less cost to sell. The risk is that, sorry, the property may not have been properly measured and may be misstated in financial statements. Yes, may be misstated in the financial statements. Now, next, goods in transit. So goods have been destroyed, 12 million. 12 billion. And they say that the contract stating that ownership has passed to them. Now, students, I will be typing its answer. As per the contract, ownership was transferred to the Mercurio, whatever it is, Mercurio, at the time of shipment. So, It was their asset at the time of after the dispatch. From the supplier. But the inventory has been destroyed. Or lost, better word, due to the ship carrying it got destroyed. Yes. Now, got destroyed. So I will delete it, which I have used, not remaining information. Students, it is still inventory in the first statements. So students, the inventory is still held at its cost of 12 million in the financial statements of company, of Mercurio company. You see here. Okay, at year end, which is above the materiality threshold. Reality threshold. This is incorrect accounting treatment. And the inventory should have been written off. So the risk is that just to show better position of company's assets, no, management may not have removed it, this amount, from inventory. So inventory is over, inventory and profit both, and profits are materially misstated. Yes. So student, now the next is insurance claim. Now student, if you have written it, you will get 3 marks. 3 marks. Insurance claim is another point. That is, if I say insurance claim, I will give a separate heading. Claim. Contingent asset. Sorry. Yes. Contingent asset. 80% correspondence was informal email. informal communication is there. Now, students, insurance policy state that, yes, insurance policy states that covered, yes, received and due to processed. Now, as per IAS, if you don't remember 37, contingent provision, contingent liability, and contingent assets. Now, contingent assets are those assets now whose existence will be confirmed by future uncertain event. Yes, uncertain event. Such assets should not be recognized in financial statements. Rather, they are just disclosed in the notes to financial statements. In the notes to financial statements. Now, and if cash inflow becomes virtually certain, it becomes virtually certain an asset can be recognized in statement of financial position. Yes. So when you see a relevant accounting treatment here, now applying to scenario here, no confirmation has been done by insurance company formally for recoverability of the amount. But informal communication amount, so it is not virtually certain yet to be received. But as per the policy terms and informal communication, the amount received is being yes, it depends upon management processing of claim. The uncertain event. You see how to relate it? So the amount of how much? 12 million into 80%. 80% recoverable. 9.6 million should be disclosed as contingent assets in the notes to financial statements. And must not be recognized as assets in its financial statements. The risk is that there may not be adequate disclosure of the contingent assets given by them, by a company. Yes, inadequate disclosure regarding insurance claim. You see here, once again, 3 marks. You see, when you are applying virtually certain, when you are relating it, in fact, you are properly may not be virtually certain. So you are basically excited skepticism, in other words. Now, next point. Receivable. By the way, how many points we have discussed so far? Just for the sake of discussion of that how many marks we have? 3 marks? 3, and in my opinion, management bias, it should have 2 marks because we have discussed some ratios and this 5 marks. And 3 marks, 8, 3, 11, 3, 14, and yes. Now, holiday pay obligation. Right, we have to discuss this. 17, and it is additional receivable. It is additional. 17, 18 marks we already done. 18 mark question it was. We say that Mercurio company has internal audit department who has been or which has been testing the control in the company's payroll system. Okay. Right. Some duplication. Okay. And then we found that capability of recording holiday taken by staff. This is not always used. Manual records were used. Now, so students, this is the point. 1 point, if we say, just a minute. So maximum 3 days. Unused entitlement, the amount is this. Pay obligation is this. Student, basically, this holiday pay obligation involves judgment. Unused, because they have to record an obligation at the year ends. So the first of all, starting with 21.1 million, right? The holiday pay obligation is material obligation for year for this year is material to financial statements of company. Now, student, you see there is too much increase from the last year, 11.6 to 21.1 million. Now, so holiday pay is directly linked with the staff. How many people they have? It was mentioned somewhere. Yes, you see here that how many employees they have. It was mentioned somewhere at the start. It was, I think, here. The word of 7,000 is in my mind. It was mentioned somewhere. The word of 7,000 was somewhere. Just a minute. Yes. 7,000 employees. The company has grown steadily and is now largest. 7,000 employees. Too many employees there are. Okay, now, so students, and there was information as well. Here it was. I read here. Just got to know. Here it was. Number of employees were here as well. Yes, 6,200 to 7,000. Too much increase. So we can write this information here as well. The obligation, holiday obligation increased by how much percent? 21.1. Yes. Now, how much is increased? Can you tell me percentage increase? 21.1 minus 11.6. Increased by 82%. 82% from last year. And increase in employee workforce. Increase in workforce is how much? 7,000 divided, yes, 800 divided by 6,200. 13%. 13%. So there is a huge increase in the holiday obligation, holiday pay obligation. Yes. So then how would it be calculated? First of all, we will tell. So students, the obligation is calculated on the basis of previous year provision adjusted for change in staffing level and pay rates. Two things are facts. So here, increase in holiday obligation doesn't seem to be holiday pay obligation, sorry, right, full words. Obligation doesn't seem to be appropriate if increase in staff is considered. Totally inappropriate. And as further, judgment is also involved. As judgment of the management is also involved. The risk is that this amount is overstated in financial statements and has not been calculated correctly this year. Risk is that. Management estimate. Secondly, manual record, which I highlighted. Manual record is being used for recording of holiday entitlements. Even computerized system option is available. So there is a risk of, there is control risk, straight. There is control risk, high control risk, that this record is not correct. And some holidays taken by employees have not been recorded. May not have been. May have not been recorded. Recorded. And holiday pay obligation. I will explain, don't you worry. Obligation. Calculated based on that record may be overstated. I will explain. What is holiday pay obligation? That you are entitled to have some monthly holidays. You do not avail that, and at the end of the year, you are paid. Now, company of 7,000 employees, and each employee is entitled some holidays, monthly or annually. So some people take leaves, some do not take. So the point is, if they are not taking holidays, so you have to and record a liability to be paid at year end. That this much holidays have not been taken. Possible. On average, assessment has to be made. There's 7,000. Okay, out of 7,000 people, normally people 2,000 do not take holidays, and they take money that has to be paid. So an estimation, judgment is involved. So, but there is a, when you are doing manual holiday recording, so again, record is not correct. With a record has to be used for estimation of obligation. When record is not correct, estimation of obligation will not be correct. Is it clear? Is that clear? Tell me. Is this point clear? Which I have tried to explain. Tell me, please. Right. Now, so this is the point, and number of points which I have not discussed yet. For example, I have done some calculation of this is receivable. Well, while the majority of sales are for cash, an increasing number of customers have credit accounts with Mercurio. The company offers credit customers 60 days credit to pay for the goods. The forecast trade balance 42 million due to growth in sales. So what is happening? The problem is too much increase in receivables. So we have not to write on this credit control. Receivables are growing too much. And the point is by 20 million. You see here, almost doubled. Now, current ratio, on the other hand, has been increasing because of the same. So we can write here. So receivable balance has increased by how much percentage? 42. So 20 divided by 22, around 80% or 90%. 20 divided by 22. $90% from last year. While last year, this huge receivable balance increase. Now, can we calculate the receivable days here to explain our point more appropriately? We can calculate. You see here, they have 22 million. And what is the sale for the year? The sale for the year is 803. So 22 divided by 803 million into 365. No, sorry, 42. Oh no, it's not available. Data is not incomplete. Their total sales, credit sales separate are not given. We need to take credit sales, which is not given separate data. Okay, now, anyways, we can write on it. Still, this huge receivable balance shows that balance increase as compared to only 7% increase in total sales.
Means that some receivables might be struggling to pay, and an allowance, a provision for those doubtful debts needs to be recorded. The risk is that company management may not have done so deliberately, as it will reduce receivable balance and hence current ratio will also be reduced, which might be a covenant for loan, as its cash balance have already been decreased from last year. You see here, now last year cash balance decreased. You see here, it is always half, less than half, has been decreased to 36 million from 81 million from last year. So, in order to show a good liquidity, management may not have written down bad debts and not recorded provision for doubtful debts at correct amount. Yes. So, hence, risk is that receivables are misstated. Now you see here, although this is additional point, but I wanted to link and give you explanation. Now, that how to explain the point, how to link two different points. Yes, Laka, please ask. Ask the question, please. Yes, please. The revenue we have already discussed about. They record revenue which they already received. That is not receivable. They receive an advance payment, then they record revenue. That is different point. That doesn't apply here. You got the understanding of it? Is it clear? Okay, good. Now, the next point is, the last point is the conclusion. And we can say over here is for receivables, that 20 million is, this increases material amount, you know. Now, so the last paragraph is conclusion, in which we have to prioritize. So we have to prioritize the amounts. The biggest amount is that of acquired stores, 171 million, if you remember. So we will put them here at the start. The first risk. Yes. Acquired stores. Then revenue recognition 10%, 80 million around. And management bias. Okay. So we can, yes, it is an important factor. Inventory in transit is of 12 million. Insurance claim is of 9 million. Holiday pay, it is increased amount. Okay, right, around 9 million, I think it was. Receivables, 7-8 million. So now they are in correct order. Conclusion. Where I said deferred revenue should be understated. Oh, so the risk is that revenue is overstated, liability is understated. You are right. I'm sorry. Liabilities are understated. My mistake. It is, I know, deferred revenue. Revenue is overstated, not deferred one. Please correct it. Okay, thank you. Next, thank you. So the next point is conclusion paragraph. Conclusion paragraph. So students, the risk of material misstatements have been ordered with regard to the amounts involved and risk of the misstatements. Misstatements. The purchase of 20 stores. Yes. Is the highest, is at the highest amount subject to risk of material misstatement. And then revenue being 10% of total revenue. Revenue. Yes. Maybe misstated. Maybe misstated. Being incorrect use of being incorrect use of timing of revenue recognition. Yes. So followed by others risks discussed are at lower amounts involved comparatively. That's it. That's it. That's it. Anyone, any question, please? Is it clear? Tell me. So we have discussed the order and why they are high risk, why they are of more importance. We have discussed that in 2-3 lines. Okay, thank you for reminding me. Just 1 minute. I will copy it in the Word document. Thank you. It will help me as well drafting my own answers later on. I can give it to the students in the regular classes as well. Which past paper it is? It is December 2022. I have copied it, but it's some format has been a bit, like this. Need to fix it. Okay, I will send it to you people here. And someone, please, if out of you people, someone can do a favor, fix it. It's formatting only. Like this. Right? Because it is time-taking process then. Now, here we go. So student, I will be sharing it with you. Don't you worry. Okay. So another question we have to do, and then I will be sharing this with you people. So today we have to do another question, but I will be taking a break once again. Just a minute, please. I'll be taking a short break, and then we will be back, and then we will be, yes. I have saved the document. Don't you worry. Okay. So I'll be sharing. Don't you worry. So see you in 10 minutes break. We will be back and we will be doing question of September 2022, the previous past paper on audit risk. Okay, students. So see you. Thank you. Yes, students, now. So let us go to the September 2021. And yes. That's what September 2022, past paper. Here we are. Same listed company, existing client, and 16 marks for evaluate and prioritize risk of material misstatement. You have to calculate materiality based on profits before tax. So life is easy in this regard. Life is easy in this regard. Because we have done the same.
Now, next. So the next point is, come to the, yes, I'll open the briefing, this one. Now, meeting notes. Meeting notes. So students, please everyone, focus it. W company is a listed, it's the same you will do. That first paragraph, means that the format, introduction paragraph, you will write, and similarly, you will proceed. Okay, now, listed company operating as a retailer. So our topic over here is, our requirement here is, that is, you see here, significant risk of material misstatement. Significant risk of material misstatement. Now, W company is a listed company operating as a retailer in the online grocery market with coverage of 75% of country. The company has a loyal and growing customer base who place order via either the company's website for an application, which can be installed on a customer's mobile phone. W company fulfills grocery orders, delivering the customer's homes via a fleet of company-owned refrigerated delivery vehicle. W company prides itself on having a market-leading inventory system, which ensures that customer can only order groceries which are currently available. Right. Next. This helps W companies customer avoid the inconvenience of any type, that ordering unavailable items. Now, next. A significant proportion of groceries supplied by W company are perishable products. They are perishable products, the sale and storage of which is highly regulated through food safety regulations. W company employs experienced food and product technology professionals to ensure that the company comply with all safety. Now, these are all business, some are the business risks in it. Okay, international expansion, right? So W company is planning to expand into foreign country of foreign by setting up operations similar to existing business. Foreign uses the same currency. Okay, the investment is expected to cost less. investment. W company does not currently have the funds for but it is advanced negotiation. What is it? Tell me. What is it? Can you figure out? This is an indication of bias. Their negotiation with the banker. And covenants are same as that of existing loan. What they are, that may be. So these two might be biases. And we have to find out that. Right, Data Protection Act issue. 2 months ago, W company suffered a cybersecurity attack in the personal information of 2,500 customers. Now, then they say that according to representatives, the company center has not properly assessed the risk related to cybersecurity. Data Protection Act led to cybersecurity attack has not resolved. W company did not make any report. Yeah. Did not report any breach. Okay, right? Next point. We'll see. We'll see. Come to the next. If there's a here, majority are into business risk. Now come to the financial information. A few points we have identified. Loan needed. Groceries, 1. Revenue. Pet foods from LPS company. Groceries revenue include revenue earned from a new initiative launched during the year by Winberry. Yes. This guarantees a weekly delivery slot for the customer. Right. Who sign up for premium delivery pass. Pass is an annual membership, similar with a $60 fee. Student revenue recognition. Similar point we did, annual membership. Annual membership. So I will just explain this point. I will not be typing it. So you can note down this point. You can note down. So it is the basically revenue recognition. I will be typing new points, but not repetitive points. It is premium delivery pass. Yes. Students, in exam, how you will be doing? You will be first of all going through the way I solved the previous question. Picking the data and identifying the point. Discussion will be at the end. Once you have done the full analysis, then you will, when you will be practicing even yourself, you will be doing the similar way. That first go and analyze the full, question. Now, listen, please. What is the point? The point is they sell premium delivery pass and charge $60 annual membership fee, right? For 12 months. So students, so they, as per IFRS 15, I will be discussing in speech. Revenue is recognized when performance obligation is satisfied by transferring a good or service to the customer. Yes. By transferring a good or service to the customer. And here, the premium delivery path covers 12 months. And service is being provided over 12 months. Hence, performance obligation is being satisfied over time. Over time. But the company is recording the $60 annual fee as revenue in advance. When no performance obligation was satisfied. Hence, the requirements of IFRS 15 have not been satisfied or have been breached. So the risk is that revenues are overstated. Revenues are overstated. And deferred income liability is understated. Now, and deferred income is understated. Now, let us proceed further. The next point is there any other point related to revenue? Second is pet goods. Pet goods, 2. W company has entered into a joint agreement with D company as investing 30 million into newly formed company, luxury pet supplies company, representing 50% share capital of the company. The remaining 50% is owned by a D company, a leading national chain of vets and pet goods suppliers. The contract behind this illustrates that W company and Durian will work together to develop the supply of the range of pet supplies, food, toys, and accessories. This joint venture agreement utilizes the established online presence of W company and their distribution network. And Durian company's existing knowledge of the pet goods supplied market. Both parties will have equal voting rights. What is it? It is joint venture. Okay, it is a joint venture to be shared. Investment is expected to take place in August 20x5. In August 20, it is July year end, right? The finance director of W company planned to consolidate result of LE as a subsidiary. Subsidiary. Non-controlling interest. 100% of L revenue separately. Full compliance IFRS 8. Despite each owning 50% have equal representation. W company's contribution. Now this is wonderful point. Now before I start discussing it, students, the amount, first of all, how much they recorded? They recorded the amount of $10 million. So first of all, we have to calculate materiality. Okay, materiality as per profits. 10% of profit, 5 million. So it is material. Material amount, materiality. Okay, now. So the second point about it, so I will type this answer. Investment in LPS company. Yes. So students, this is when they did it. Yes. They are consolidating it. The revenue from LPS company consolidated in financial statement of, what is the name of the company? Winberry, are 10 million, which are greater than materiality threshold of Winberry company financial statements. Yes. So it is material amount. First of all, material amount. One thing. You see here, consolidation of 60 million. You see, 60 million. Secondly, net asset of 60 million of LPS being consolidated to Winberry company statement of financial position. Financial position. Which is also a material amount. Amount for it. Yes. Now, students, First of all, materiality discussion. Next. The next point is we have to discuss what IFRS says. As per IFRS, an arrangement where two parties have joint control and right to the net asset of the arrangement. Yes, it is called a joint venture. Joint venture. Yes. And here, Winberry now. And now applying to scenario, Durian company. Both hold 50% share capital of LPS company. Yes, each. Now, yes, they each 50%. And as per the contract says, work do together. Both will work together. Both will work together to develop the product of the LPS. Both will have equal voting rights and equal right to as net assets, equal right to net assets and profits of the company. You see here. So both entities are sharing control and right to net assets. And it is a joint venture arrangement. It is a joint venture arrangement. Now, as per IFRS, investment in joint venture should be recorded using equity method of accounting. Equity method of accounting. Yes. But here, now applying. But here, who is saying finance director is saying? Yes. Finance director of W. Here, finance director of Winberry company Winberry company intends to consolidate the financial statement of LPS with Winberry, which is against the provision of IFRS. Even despite of the logic that Winberry has better knowledge. This is the knowledge has contribution of knowledge is greater to the joint venture. So only on the basis of this contribution of knowledge, it can't be regarded as subsidiary of the company of the Winberry. Why? As per IFRS, a subsidiary of an investment can be classified as subsidiary where parent has got control of the company invested in. Company it has invested in. Control. But here, this control is shared equally for LPS among Winberry and Durian company. Yes. You see how this is the most important thing is relating, explanation, specific to the scenario. Now, it's shared. So it can't be regarded as their subsidiary, as a subsidiary of Winberry. So students, if the finance director, the risk is that if LPS is consolidated with Winberry financial statements, its assets, profits, and revenues will be overstated. Will be overstated. Let us proceed further. In January 20, okay, next point. So operating profit, we can calculate margin. Yes. Just a minute, please. Yes, margins we can calculate. Revenue increase we can calculate. Because this we must have to calculate. These are the points. Now, 3. Damaged warehouse. Okay, damaged warehouse. 70 and 67, right? There was a fire in one of the Winberry company's 5 warehouses, which completely destroyed the premises. But fortunately, no staff was injured. The warehouse serviced the northern region of Winberry company's customer base. The finance director has not written down the carrying amount of warehousing property, plant, and equipment, as he is confident that company will cover all costs. Okay. The insurance company has confirmed they'll repay the inventory lost. However, the claim is still ongoing. Winberry was able to utilize their remaining. Now, students, fire, house. So the point is, how much? 67 million. Damage to the fire. Carrying amount. Yes, it is 67 million. It's a materiality. Then impairment. Impairment. Because they are property, plant, equipment. They're impaired. So let us discuss it. So damaged warehouse. Damaged warehouse. Now, how to discuss it? Yes. The value of the warehouse is more than the materiality threshold. So it is material to group financial statement, to the company's financial statements. Yes, materiality. So, as per IAS 36, an asset is impaired when its carrying value is greater than its recoverable amount. When its carrying value is greater than its recoverable amount. Now, students, next. And recoverable amount is higher of value in use and fair value less cost to sell. Cost to sell. Yes. So students, here the company is not using the warehouse after the damage. Yes, not using. They say we are using the other places. They said it clearly. You see here. Remaining 4 warehouses of the damage. You said that. And are using just a minute, please. And are using the remaining 4 warehouses to supply the areas which were previously covered by this damaged warehouse. It means it clearly indicates that it has no value in use in its current condition. You know that? Logic, argument, applying to scenario. And fair value less cost to sell. Cost to sell is maybe lower than its carrying value due to damage caused by fire to building and machinery. Yes. They have written down. Policy will cover. So an impairment loss should be recognized in the respect of, in respect of this building. in respect of this building, impairment loss should be recognized. But the finance director is unwilling to do so. As he is confident that insurance will cover this loss. Even the loss is covered by insurance later on, that has to be recognized separately. Separately. So, this is again the requirement of IAS 36. Yes. And property, plant, equipment and are overstated, and impairment or cost are understated in financial statements. Yes. Students, the second point is insurance, contingent asset. Remember that? Remember that. We did in the last question. A separate point you can note on that. Same discussion applied here. Remember the previous question? Overstated, sorry. Overstated and understated. Yes. Is it clear? Now, next. The next point is, so the other point you can write about it regarding the insurance claim, right? Contingent assets. Okay, you can discuss that here. The way we discussed in the last question. So, next. Students, remember one thing. We must keep an eye that we must not need to discuss the points more than required marks. 3 marks per accounting issue. So 6 or to 7. Sometime you see here, this one accounting issue was there. We have 2 points. So 6 marks from it. These are 2 points. Similarly, investment in LPS. In my opinion, it should have 3, 4. Minimum 4 marks. The reason is there are 2 aspects discussed, joint venture and subsidiary as well. So 2 different accounting treatments discussed. So minimum 3 will be there, but 4 up to 4 marks. Now, next. The next point is, come to that. Long-term borrowing comprises a bank loan. Okay, come to the financial statement. Bank loan, long-term borrowing. 5 and 33, too much increased. You see how much is increased? Now. So long-term borrowing comprises a bank loan taken out by the Winberry company to fund the joint venture of LPS with Durian company and the purchase of electric delivery vehicle. The bank issued the loan same term as their that interest cover is maintained at 3. Interest cover. So it means they might be manipulating its profit because interest cost has increased. So in order to maintain interest cover 3, yes, so loan, they might be some bias. So pressure on results. We can write a point here. Management bias. Similarly, pressure on results. Okay. On management for better results. So we can discuss their profitability increase, biasness, incorrect accounting treatment, loan covenants condition. Can you please discuss it for me here? Would you like to write this answer on it? I am giving you hint. Would you like to write answer now for my review on it? Management bias? Only one person is willing. No, I won't proceed for it then. I can leave it. One person is agreed. So I will write. Don't you worry. Okay? I will write. So, students, company, yes, is a listed company. Listed company. And it has to show improved financial results to its shareholders and prospective investors. Secondly, which has, so management is under pressure to show improved financial results, which is further increased by loan covenants to maintain interest cover at least 3. So management might be biased while recording expenses and sales to achieve these results by manipulating different items, such as they have not recorded any impairment loss on the damaged warehouse. You see here, they have not recorded. Damaged warehouse. As it will decrease profit too low. Profits by a huge amount. as well as they are recording revenues of annual subscription, at the time of, at incorrect timing. And hence, it might be an attempt to show increased revenues. Yes. Or overstated revenue. Increased revenue. Yes. In order to, and hence there is high risk that assets, sales, and profits may be overstated. You further can improve it. How? You can calculate increase in ratio. Sale have increased by this percentage. Margin, the way I did in the last question. Further, you add more spice, flavor to the answer. So the examiner gets feeling, yes, this student has done a wonderful analysis, link different things. That will be wonderful if you do this. Now, next. Anything else? Any other exhibit? Yes, there is an exhibit. So the next point is, right, search results for Winberry Company, 3rd November 2024. Keeping up with demand. Winberry ahead in home delivery grocery revolution. The Groceries Trade Journal, perishable pan report that demand for online grocery delivery has reached an all-time high and showed no sign of slowing down. Traditional supermarkets cannot keep with the demand, leaving opportunity for gain in the market for online operations. Okay, right? No worries. So this has nothing to do with our what we can say, risk of payment statement. Yeah, 15 January 20x5. So what is the year end? Year end is, yes, year end is here. First July, 30th September 20x5. Okay. A group of local residents who claimed their health was affected by toxin fumes from the huge, yes, from the huge fire at Winberry, right, company. Northern Warehouse are bringing action to claim for compensation. The local legal representative confirmed that they have served a claim against the Winberry company. Yes. And they believe that they were health and safety breaches. Right? There were health and safety breaches due to the failing in the sprinkler system and bringing the fire under control quickly. Okay. Winberry's Health Safety Department has launched investigation, concluded warehouse staff has manually overridden the automatic to prevent water damage to goods. Oh my goodness. This is very easy, in my opinion. But this is, in my opinion, this is a material by nature. This information is material by nature. Now, let us write about it. Claim. Legal claim against the company. Yes. So the legal claim, when we talk about, yes. So local resident, yes. So local resident brought a legal case against the Winberry for health and safety. Yes, for health and safety breaches. Yes. The amount of this case, this claim is not available, so it can't be regarded as it is material or not for the company. Yes. As per IAS 37, a provision should be recognized when there is a present obligation from past events and outflow of economic benefit is probable. Yes. The fire in warehouse is a past event, which occurred already. Now, and whether it has a harm and if it has harmed the people, the residents, health, then there is probable that a compensation may need to be paid. may need to be paid and is probable. And if it is the case, a liability, a provision for this liability should be recorded, should have been recorded. By company. You see here, linkages should have been recorded. Now, the risk is that the necessary provision may not have been recorded and liabilities and expenses may be understated. Liabilities and expenses may be understated. Now, next point. The next point is, and if there is a possible obligation, yes, if the possible obligation then a contingent liability disclosures needs to be made in the notes to financial statements. So there is a risk that disclosures may be incomplete. Now, student, this is very important thing. Another, immediately, skepticism. Skepticism, what's that? We got this information from internet. So this case, auditor obtained this information of the case. Now this is professional marks of the case from internet searches. And management didn't inform auditor about it. Yes, it is a serious question mark on the integrity of management and credibility of information provided by them regarding financial statements, as there might be other similar methods. Other methods. There might be other methods. Not disclosed to him. There might be other methods as well. Not disclosed to him. I hope it is clear. So, auditor should and it's enough. It's enough. So you see here. So this is basically professional skepticism. Professional skepticism. Applying. Now, so the next is eco van friendly van, 18 February. Okay, we'll see that. What is it? A new fleet of 80 electric vehicle costing 50,000 each. Now, so have caused delivery kiosks. Yes. To Winbury company's loyal customers. The vehicles can only travel for 100 miles without requiring recharging, which has left customer experiences delays of up to 4 hours for their groceries. The eco-friendly vans are initially selected for purchase by management based on a suitable delivery range. However, at the request of Winbury Company, the manufacturer of the van added refrigeration units. Okay. Just a minute, please. Okay. So at the request of the manufacturer added refrigeration unit to each vehicle, which has significantly reduced the distance the van can travel on a single. Oh, really? So what is the point, basically? So 50,000 each. 80 electric vehicles. How much? 4 million. So we can assess whether it is material or not. Because they're not delivering and delivery distance has reduced. Now, so student, before it was traveling 100, now it has reduced. So whether they are impaired because customers are not happy. So, students, this is the point. They were traveling before 100 miles, but now, I repeat in simple words, try to understand the point. Company has fleet of 80 vehicles through which they deliver to the customers. Goods, they order. Before they were delivering one van with one charging for the 100 kilometers. But now they have added another, because some products require refrigeration. Okay, so they added refrigerator to that as well. Now that duration, that 100 miles, they can't travel because there is refrigerator as well within the van. It is also consuming battery. So the point is, so they are not generating those cash flows. For example, in 100, before that, they were traveling 100 kilometers to 10 customers, for example. Now significantly reduced. They might be traveling to the 4 customers in one charging or 5 customers. So cost increase, cash inflow, value in use reduced. Okay, so they might be impaired. So impairment loss may be charged. You got my point. You got this understanding? I will be typing the answer, but you got the understanding of the issue? You know, just if you want to just try to jump and writing the answer, that is not good. First of all, try to understand the issue. So, have you been able to understand the issue? Tell me. Yes. So, eco-friendly delivery van, which are how much? How much they are? So eco-friendly delivery vans, the vans have a value of 400,000. How? Oh, sorry, never write K. 400,000. How? 80? No, 400,000. 4 million. Sorry, 4 million. Because 80 van into 50,000 each, which is material or not, you can write. Okay, material or not, because you have to calculate materiality threshold overall, and then you can discuss. As per IAS 36, if carrying value of assets is greater than recoverable value, then an impairment loss should be recorded. An impairment loss should be recorded. Now, then it's recoverable value. And recoverable value is higher of value in use and fair value less cost to sell. Fair value less cost to sell. Fair value less cost to sell. Value in use is calculated as present value of future cash flows generated from the assets. The electric vehicle, now I'm applying vehicle, van, are now traveling for reduced schedule per recharge of the battery. Per recharge of the battery. And are making less deliveries. So their value in use have been reduced. Yes. Reduced. Their fair value, less cost to sell, may also have been decreased due to their reduced performance. So, their recoverable value may be less than their carrying value. And an impairment loss needs to be recognized for them. And their value should be written down in financial statements. The risk is that just a minute, let me complete it. The risk is that they may not have recorded any required impairment in financial statements, and impairment expense may be understated, and assets and property, plant, equipment, that is eco-friendly van value in non-current assets may be overstated. Yes. Now, the question is, does the refrigeration unit increase the value of vehicle? A very valid question. I appreciate this question. I appreciate. Listen. What is the purpose of delivery van? The purpose is to make delivery timely to the customers. Before they were, for example, delivering 10 items per, 10 customers per charge. Now they're delivering 5, 4, 6. We are talking about present value of future cash flow. The purpose, remember, the car you have, the value of car is not the individual value of each component. You say chair is 20,000. Okay, steering is this plastic material is this. No, It's not like that. It is a package of benefits you buy. And you pay a huge amount. If you start calculating the cost of car, it may be much less than iPhone. What is the cost? And what I buy for? You know that benefits. I buy benefits for me. The value it is giving me. You got my point. So similarly, non-current assets. Value in use is present value of future cash flows. The value of that delivery van is not just the amount, the individual parts value, cost. You got my point or not? You got my point or not? Good. Now, so this question is also done. So then magnitude of misstatement and likelihood of now. Which one has the highest magnitude? We can put that first. Because you have, I think that is the damaged warehouse has the highest magnitude. Right? We will put first. Then investment in LPS, I think. Okay? Right? So damaged warehouse has a higher risk of misstatement. Highest amount, you can note down this point. Conclusion you will write in the conclusion. The damaged warehouse has highest magnitude amount, quantitative aspect, and there is higher risk of management bias that they are not recording impairment. So higher risk of material misstatement is there. So that should be the first risk. Okay. And secondly, the second is the venture investment. They're investing 60 million, a huge amount. And but they are they are not applying the accounting treatment correctly, as said by finance director. So highly risk of misstatement. Right? And the further are 2, 3, then further are followed by the other. Okay, it's like that. Is it clear to everyone? Is it clear to everyone? Good. I'm happy. So let me copy it as well, this answer. Just a minute. It is September 2022. Yes, the next is September 2022. Yes, question 1. Its answer. Okay, so who is the volunteer? I can send this document Word. The person will do just formatting. Any volunteer there who can text me via WhatsApp? My WhatsApp number you people have. I can send it. Otherwise, I will take time. You know, I'm not doing it now. I might be doing it tomorrow. Okay, then I can send you the answer. This document. After doing necessary formatting. You know, formatting has been disturbed. Okay, Anjani. Oh, but not today. Tomorrow I can do. No worries. Okay. Right. So, all right. So, students, thank you for joining me. But, what I need you to do, because you have full week for this. In my opinion, you should work on it. This exam kit I have shared with you people, updated format questions are there. Yes. So updated format is questions are there. Yes, I'm going to give, don't you worry. Okay. I'm going to give you an assignment. Don't you worry. solve pale company. You should try maximum questions. You will solve this question, pale company, okay? March 21, and send it to me, okay? Yes. Note down, send it to me, and do send in the PDF format, okay? And then send me a text that you have sent me, that assignment sent pale company, okay? Please do this favor to me, right? So send it to this email address. I'm sending you, outlook.com. Try to send it in the next 3 days so that I can mark and return it to you, okay? This email address, pale company, yes. It's this part, audit risk or risk of material statement. Okay, students, thank you for joining me. God bless you. Right? Take care. Goodbye. Goodbye.
Thank you.
Thank you. Goodbye. Goodbye.